Κυρίες και κύριοι, συνεχίζουμε τη συζήτηση και το νέο κύκλο συνεντεύξεων στο CapitalTV με ξένους senior αναλυτές, οι οποίοι είχαν μιλήσει εδώ στην ιντερνετική τηλεόραση του Capital.gr πριν από λίγους μήνες σχετικά με τα της ελληνικής οικονομίας. Φιλοξενούμε σήμερα τον επικεφαλής fixed income παγκοσμίως της HSBC, τον κύριο Steven Major, ο οποίος βρίσκεται στη χώρα μας, ήρθε από το Λονδίνο. Hello, Mr. Major, thank you for being again with us on CapitalTV. And in our last interview, you had told me that Greek bonds are an investment opportunity.
Yes.
Do you still believe this?
I do believe it, especially for the long-dated bonds, and I think it's a great opportunity for individuals and institutions to buy the 30-year bonds, because the price is so heavily discounting the worst-case scenario that actually it's the right time to buy. And we all know from investment theory and practice that you should always buy when everyone else is selling. So right now, the very long bonds are offered at such a huge discount. I think it's the right time to buy them.
Would you invest on short-term bonds, on Greek short-term bonds?
Actually, no. This is probably a strange recommendation, but for me, the fact that there is financial support for the next 1 to 2 years, maybe for the next 3 or 4 afterwards, does not mean that there won't be some kind of event. Now, the people are assuming that because the IMF and Eurogroup is supporting Greece with the refinancing, that excludes any possibility of there being a restructuring. And I think that that's not right. I think that there is a non-zero risk of there being a restructuring at some point in the next 2 years. And that means that the bonds at most risk are the short-dated ones. These could be extended in maturity. So you could buy a 2-year bond today, but next year it could suddenly be a 10-year bond. And that's not what you bought. So they may look like good value in yield terms, but actually they carry a lot of risk.
So you think that if there is a possibility of restructuring for the Greek debt is in the terms of lengthening the duration of paying the debt rather than haircut?
Well, yes, I think it's much more likely to be a restructuring, and a restructuring could involve some kind of haircut. But my opinion on this is it needs to be friendly. So maybe there is a scenario that we could look at here whereby in 1 or 2 years, as long as Greece is along the right path and is delivering the kind of measures that have been required from the Eurogroup and IMF, then there has to be some reward. So as part of the process to help the Greek government and the Greek people, maybe there is some relief that could be organised. But it has to be a restructuring that would work for both the holders of the bonds and for the issuer of the bonds. And for me, that's what I call a friendly restructuring.
And the scenario of restructuring means that Greece won't be back early in the markets, right, in the bond market?
It doesn't exclude that possibility. And if conditions are good enough at the back end of 2011, even early 2012, I see no reason why Greece couldn't issue. Now, we have to look at what the world conditions are going to be like, but if yields were closer to 6%, which I know is much higher still than the 5% roughly that Greece pays, even at 6% it might be worth looking at a short-dated issue. Don't forget, public issuance is free of any condition. So without a condition, it seems to me to be quite a good value. So I wouldn't exclude that possibility. Some point in late 2011, 2012, it's possible, maybe it's a 40-50% possibility that Greece could return to public markets.
Don't you think that Greece will need more money from ECB, IMF and the European Commission?
Well, I think that the troika of support will remain in place. So the ECB's role is to continue with liquidity, offering it via the repo for the banking system. The role of the Eurogroup and IMF could be to extend their help, maybe beyond. And in fact, indicating that they are willing to go beyond 2012 might actually create the conditions whereby the yields come down and Greece can issue in the public markets. So I refuse to discount this possibility.
So talking about investments, which do you think is the best or the safest investment if we're talking about bonds for 2, 3 or 5 years issuance?
I think it's right to still be optimistic on the fixed income markets because the economic conditions are challenging. The US, UK and Germany, for example, are all suffering the same kind of pressure. We have the risk of greater debt deleverage working through in the next few years, and that means a deflation pressure. Now, a backdrop of deflation is good for bonds. It means that you are preserving your purchasing power. So I could see yields in the US going from the 2.5 level down towards 2. In Germany, they could even go below 2. For the UK, they could go towards 2.5.
So you don't suggest Eurozones or US bonds? Maybe what? Canada, Australia, the safest economies?
Well, I would say that in the Eurozone, the best bonds to buy are probably the German government as a core asset. Spain and Italy are doing reasonably well and a good value at above 4%. And then there's the very long Greek bonds. I suppose globally, I would look at Canada, I would look at the UK, Sweden, those countries that have their own currencies have the flexibility which they've already been using. They've already, in some cases, devalued their currencies. Therefore, they offer good value in credit and currency terms.
Thank you for being with us, Mr. Major.
Thank you.